Ladies and gentlemen, I believe like most of you can agree with me that DeFi is still a very dangerous place to be in. Even if we just look at the last recent events, what we witnessed from the Terra Luna crash, which happened last summer, where we were thinking, okay, this cannot be true. Actually, it was just the beginning. I believe most of you are aware that then FTX did break down last November of last year. Then we had the USDC DPEC event happening in combination with the Silicon Valley Bank. And lastly, the Euler hack reminded us again how dangerous DeFi can be. I mean, we should ask ourselves, why is this happening? What is the reason for that? And I mean, we have these security companies who are doing audits like Certic. Then we have companies who are doing incentive designs on these DeFi protocols like Chaos Labs. And yet still we have constantly these kind of events. And we cannot talk here about black swan events anymore because these kind of events happening a few times per year. It's more of a systematic problem. And the question is like, what's going on? Why is this happening? The reason is like, when we look at the protocol design, like all of these companies, all these hacks are 2 to 5 years old. So basically some kind of audit is done. And basically, what you can immediately see what's happening, like there is a huge interest from DeFi. So basically, a lot of liquidity goes immediately to that space. But the problem is like these people who put the liquidity, they don't do any kind of due diligence. They don't have tools. They don't have the way how to analyze, how to assess the risks they are taking for that. The promise of DeFi was actually to build a new financial system, which is going to be like open, transparent, secure, without a central entity. And what did we achieve until now? Actually, we have a worse version of the traditional finance space because those kind of events are not happening constantly there in this space. And if we want to put DeFi on a mainstream, we have to rethink risk in general around that. Few words about myself. I'm the co-founder and CTO of Solity Network. I spent most of my career in corporate development, working for major German corporations like Audi, ZF, E.ON. I'm in crypto since 2016, building mostly in the DeFi space, and I co-founded Solity beginning of last year. We closed our first round in September of last year. We have offices in Munich, which is our headquarters, but also in London and Zagreb, and a very strong team. Out of 18 people, I'm also happy to see Vedran here, who is going to lead the activities here in Zagreb, out of which 14 are in the development side. Now the question is like, why do we have this systematic problem that constantly some kind of hacks or risk events are happening? And I believe these slides puts it actually very well together. I believe most of you who are in DeFi space for some time are aware like that these stablecoin related strategies where you have your stable coins, you put it on some kind of yield aggregator, and then you can get some kind of yield on it. It was very popular, a lot of liquidity was put there. But the thing is like, what people don't understand is like when you activate some of kind of these yield aggregators, you are activating all these primitives here. And what is DeFi? DeFi is nothing else than a composite of various primitives. It starts with the chain. I mean, we are all aware of Ethereum. Now we are talking here about L2s like Arbitrum, Starknet. We hear already discussions about L3s, L4s. Then usually if there is a cross-chain strategy, then some kind of bridges involved in the whole topic. On the other side, we have chains like Avalanche, Polkadot, Near Protocol. On top of them, there are like subnets, parachains, charts, and so on. On top of these chains, these DeFi protocols are then deployed. Usually, these are lending and borrowing protocols or AMMs through which the yield is generated. We have these liquidity pools. In these liquidity pools, there are various stable coins, and on top of them, there are then these yield aggregators like Yearn Finances, yield optimizers, who basically checking the lending borrowing rate and doing arbitrage on that side, or just moving the assets depending where the highest yield is. And lastly, we have also for these DeFi protocols like oracles. They are needed to get some kind of real data information, for example, the price for the proper working of the protocol. And the thing is, like, even now, this is going to get even more complicated with the introduction of the newest innovation on the consensus layer, where we introduce shared security, risk-taking. The whole complexity is going to be even much bigger on that side. But what is the problem? Like, the problem is, like, all of these primitives have their own underlying dynamics, their underlying risks, and those risks are actually outsourced to the end user. So basically, the end user has to take care and to do the due diligence if he wants to invest in DeFi space. And how does it look like? It's something like this. So basically, we have the chain level. On the chain level, we have the validator, we have the slashing events, then we have the governance structures. We have on the L2s, again, on a new governance structure, we have the sequencer. Then if there is these DeFi protocols, we have the security issues behind smart contracts. On top of that, liquidity pools. We have to take care about liquidation on lending protocols. There are liquidity pools. If we get inside, we are not sure we are getting outside. Then we have these yield optimizers, yield aggregators. They are introducing new security issues because smart contract is written. New centralization issues are coming to the table. And especially if there is a cross-chain strategy, then we have a bridge. So basically, finality of one chain combined with the finality of the second chain. And basically, the bridge makes the thing actually worse. And lastly, like, we have also these oracles with their data consistency. So many attacks from history happened actually through these oracles. And once these risk-taking and shared security mechanisms come live, so basically these middlewares are going to be secure, kind of secure, but the reality is basically if there is a breakdown, then we are talking a totally different level of a systemic risk. Because then it's not about systemic risk that some kind of DeFi elements are infected. It could be like that even the attack on Ethereum can be deployed. And now the question is, like, how to deal with that? I mean, we cannot deploy some kind of risk analyst in the backend like we do it in traditional finance who analyze that and say, okay, let's do that or do that or do that. Because DeFi is a 24/7 business, we need a different approach here. It has to be automated, and that's basically what we at Solity Networks are aiming to do. So our approach is to utilize big data. So we are indexing and monitoring the whole DeFi ecosystem, starting with the L1, L2 chain, with the DeFi protocols, stablecoins, bridges, oracles, including liquidity pools. Our focus is on the fundamental side of the risk. So basically, we are getting data around security, liquidity flows, decentralization and governance, development activity, and socials. We are enabling our customers to use our infrastructure to build risk-related products. And the feature of our infrastructure is basically that everything is in real time. We are, of course, aware, basically, when we are building this kind of infrastructure, we should help these DeFi protocols and not be the attack vector. And that means we have to rethink and build a new infrastructure in a totally different way what we know from the traditional finance space. And that's basically the core element of Solity Network. We are building this AI-powered risk infrastructure, and the whole idea is that we have a data validation layer. So basically, we are running our own nodes to get the on-chain data. We also have a data pipeline with our own Lambda functions to get the off-chain data. On top of that, we have an infrastructure routing layer. Why? In discussion with many customers, we realized basically all of them are in a different stage of decentralization. All of them have a different understanding of decentralization. Some of them want to have a centralized immutable database. That's enough. Some of them want to have decentralized databases. Then the topic of computing comes together, like, do you want to have some kind of decentralized compute network, off-chain computing, or just normal computing is enough? And then in the end, what is about delivery? And it's getting even more funnier when you then try to discuss with them what is the best solution, and then you tell them, like, it's not for free. You have to pay for that. And then the discussion starts again in a new way. And that's the reason why we said, okay, let's build a routing layer where we will provide the option to the customer to build these routes and then share the costs through that. On top of that, we enable processing. So basically, our customer can run statistical models, do network analysis, run machine learning, deep learning models, or other AI-related algorithms to build these risk-related products, like, for example, customizable risk scores, which can be used for example in traditional finance space for portfolio rebalancing, or on a DeFi space for vol strategy rebasement. This could be like more advanced risk frameworks for insurance protocols, for liquid staking, but it could be also a monitoring and alerting system if there is a trading infrastructure in place or a new chain or a protocol is deployed to create more transparency. And lastly, the delivery is, of course, again a discussion. Some protocols are comfortable to use APIs. Some of them want to have this delivery on-chain through oracles, but also we are going to enable options that customers can build extensions to provide more information for their end customer, or to build some kind of chatbots to provide information what kind of risk they are taking. And then in the end, we have these customer groups I already mentioned, like from lending protocols, AMMs, yield aggregators, up to insurance protocols, or some other protocols we don't see it or we don't understand it at the moment. I believe the most important thing of this infrastructure is actually that we want to open it up. So basically, besides that we provide the data, we want to enable also third-party providers to provide data which we don't have, which is needed for more advanced risk frameworks. And we also want to provide the option for third-party solutions to provide part of their processing infrastructure to complement this here, to build even more advanced risk frameworks. For example, a good case would be like agent-based simulation modeling, which is a very specialized infrastructure. And then on top of that, we are going to incentivize everyone to build their own risk frameworks. So basically they can earn yield on top of that if this risk framework is used, and the consumption is of course happening through the token level in itself. From experience of protocols from history from the last 4 years, we learned that actually it's not a good idea to start immediately with decentralization and opening up the platform. So basically, if you want to create a network effect, you have to create immediate value for the end customer. And that was actually what we were doing for the last 9 months. And I'm happy to announce that we basically launched our beta solution last week with 30 design partners and a first paying customer. And our focus was from the beginning really to make the interface as easy as possible to build a risk framework with various levels of knowledge. So basically, you can create a default risk framework already used. You can go in smaller optimizations, or you can go, like if you're an expert, you have domain knowledge, utilize that. And how does it work? Just to give you a short teaser, it's a very simple case. So basically, let's, in this case, create a BlockSplit risk framework. So basically, just clicking here, call it BlockSplit risk framework, and you see immediately like what are the primitives the user can select. It starts with the chain, with the protocols, bridges, oracles, stablecoins. So basically, the user just defines the ecosystem he is going to run, what type primitives are included there. He clicks save, and then the default risk model is deployed. And as you see, we build it in a way that there are sub-risk models which have a different methodology how to assess the risk from security up to liquidity, and then overall score can be built on top of that. We then enable in the second step the option to the end user to decide if he wants to change the risk framework a little bit, the default setup, in a very easy way. So basically just, for example, he doesn't like the development activity as a part of overall score, or he doesn't want to have socials there that represented in that way, it's very easy to change that. And lastly, if the end user has expertise, domain knowledge, he can go on the parameter level, he can check the models we are using, and change the weighting factors for these all parameters which are there, to get something out of which is basically better tailored to his end solution. And that's it. So basically, as you see, it's very, very simple, very intuitive. And from here on, we are now going in the direction of opening up the platform and decentralize the whole tech stack. And I'm also happy to announce that we are going to launch our official product launch by November at DevConnect, together hopefully with all of you. And to conclude, I believe DeFi in this current form has to change. We personally believe risk management is going to be core, like data-driven approach to smart contracts, that they can anticipate the events which are constantly changing. And I believe the quote from Dan Moorhead is still on time. So basically, the future of DeFi is going to be defined through risk management, and we at Solity Network believe that we are going to enable that. Thank you. If you have questions, feel free to ask. We have 1 minute time left, or just join our Telegram group. You can ask their questions directly.